everyone. Thanks for joining today. We are Peterson Wealth Services Point of View, Billy, Shaun, and Cade. Today, we're talking about the market volatility. Of course, if you're paying attention at all, you're probably getting word that the markets had a really difficult day on Monday, and the volatility index spiked a bunch. We've had a lot of concerns. Felt like it was a really good time for us to reach out, send you all a little bit of a reminder, and point out some things or why we're in this situation and what's causing this.
Well, I think that's a great point, Billy. We've seen volatility spike, and I want to start there, and I want to share my screen with everyone to kind of show a measurement of that. So I don't know how many people follow this too closely, but the VIX is an index, and that's VIX is an index that we use in our world to measure volatility. And this chart just shows some different events that have happened over the past 15 years or so. More recently, we saw this COVID spike where the VIX went up to 82.7. This latest read says 23.4, but today the VIX actually spiked up to 65. So it's got people worried, definitely seeing some more volatility in the market. And I think we go back to this and remind people that volatility is normal. If you're going to be an investor, you've got to expect to see some ups and downs sometimes. And it's not uncommon to see this. And I think that kind of leads us into our next point here that Cade's going to talk about.
Yeah, this next chart here is showing the S&P 500 pullbacks each year, and this is a 5%. And the point here is just that these are so normal. They happen on average 4.6 times every year. We've only had 2 so far this year, so we're below the average. So it's totally normal. It's not something that we're worried about right now. And into the next chart, it will show you a little bit more significant in the 10% pullbacks. So on average, there's 1.2 of those every single year. And the difference with this chart is that there's this orange line, and it's showing the S&P 500 index price, despite these pullbacks, which sometimes they're as low as 0 in a year or all the way up to 8, which we saw in 2008. But regardless, that line is still trending upward. And that's what we're trying to look at, is the long-term performance.
Sure. And I think the value of staying invested, this chart here really is something that people should look at and understand. And I want to walk through it. It's saying, okay, if you were buying and holding with your you made $100,000 investment, and you went through, they say market crash here, this gray line here, they say market crash. We don't like that term in the office because crash sounds like you went down and you never recovered. We call it maybe a bear market, or again, a pullback or a correction. So shows 3 different outcomes. First outcome is you move to cash during this market downturn. And that's represented by this red line. So your 100,000, take it all the way out to 2020, August 2nd, 2024. So last week, your 100,000 grew to $143,000. Not a very good return. If you moved to cash for 1 year and then got back into the market, and by market, we're talking S&P 500, your 100,000 grew to well over $500,000 in that same time period. If you buy and hold, which is what we've always preached, your account, your $100,000 grows to over $900,000 in that same time period. The one they don't have on here that I wish they did was the stay invested and actually add. Okay, so the ones that buy during a market downturn are usually the ones that perform better over time. So again, it's just going back to what we talk about all the time, is staying in the boat. It's just like the analogy we use 100 different times, where you're on a cruise and you hit rough waters. Those that jump and try to swim to shore probably don't make it. Those that look towards the captain that's been there, navigated storms, get through that, and then you're off to smooth seas after that. So anyways, Cade and I talked a lot. We're going to turn it over to Billy, and he's going to have some things to say too.
Well, and that chart kind of sums it up, because you don't know exactly when these things can occur. They talk about these corrections, and people a lot of times get swept up with their emotions and they decide to react. And it's usually at the wrong time. I mean, reacting is a bad term. We always want to say, let's play offense and try to anticipate things and make changes well before other people are talking about them. It's interesting to watch from our chair the people that these news networks put out on their network after the fact. And it's always like, oh yeah, I knew this, and we should have done this, and you're doing this and we're doing that, and buy these stocks. It's really interesting because they're just generating buzz or eyeballs to follow their trend now. But
The
where
ones
were
that
they?
are amazing to me, Billy, I swear they have it. Like as soon as the market corrects, they just hit send. It's the gold and silver. Like
Yeah.
every day coming to the
Oh,
office,
the
when
ads are
market's
gonna
down,
pick up.
gold and silver. Just
Yeah.
yeah,
We've been
this-
recommending this. We knew this was all going to unfold.
of
Well, of
course.
course, the market is going to slow, and we've been talking about that for a while. We don't advocate just dumping everything and going to cash. If you've watched this or listened to us or you're a client of ours, you already know that about us. Staying invested long term is what we believe in. It's the only way to build wealth over a long period of time is to buy good quality companies, be a business owner, and stay with those companies. It's the same way if you'd started that business out yourself. If you created it, you're not going to look to dump it just because somebody said the value was lower, or somebody offered you 20% less than they did the day before. That should not concern you. You should not be reacting to that kind of thing. So stop watching the news. Stop worrying yourself sick over all these things that are being displayed and looking at your monthly statement and saying, well, this is permanent. That's why the word crash is a terrible term, because crash sounds like something that's irreparable. You can't come back from it. And you always do. Just look at the charts. But the thing about this economy is it had to contract in order to bring inflation down. There's no other way around it, guys. The Fed had to generate a slowdown in the economy in order to bring inflation back to the level that they are mandated to do, which is a 2% level. So starting to see some signs of that, where businesses are laying off employees or sales are starting to trend lower. Consumer discretionary is one of the key areas that start. Consumer discretionary stocks, the things that we don't have to have. Well, the sales are starting to slow. These negatives are starting to pop up. And the media loves to grab every headline and sensationalize it just to create fear. And the fear creates people tuning in. They did this during COVID, right? You guys don't even want to get me started on that. Go back and watch some of our videos. All of that was overreaction and didn't have to occur, but it did because most of the media made a killing during that period of time. Let's talk about what's gone right in the market. And the market has had an explosive growth in earnings due to the Magnificent Seven. We've talked about that before. Those are the 7 basic companies that are involved in information technology. Year over year, they've had tremendous growth. Earnings per share growth of 17.5%. And now we're starting to see that they are reining in. The growth is still there. It's still coming in, but not as high as it was before.
They're lowering their guidance too. They're kind of preparing people for a slowdown. I think that's why we've seen some weakness in those names in the tech space.
Right.
Too.
And that's like, hey, shoot it first and we'll ask questions later. Most people are just say, get my money off the table, chips off the table whenever there's a risk off scenario or feeling. So grab your money. And you saw that with the cryptos. They got absolutely hammered. So if you think about, Apple, Amazon, Meta, Google, all those companies that are kind of like the pride and joy of the S&P 500, dropped anywhere from 3 to 7 or 8% today. And some of these cryptos dropped 10, 15, 20%. You see where the risk is. We talked about that at length. All right. But if you think about the market from 2023, the start of 2023, S&P has given us 40% return with 6% earnings growth. One problem there. If you take out the 7 stocks I just mentioned, the Magnificent Seven, then you only had a 19% earnings growth, 19% total return. And earnings actually fell or contracted 2%. So you can see why those companies gained all the interest in the market in the last year or two. And they've driven markets higher. So what's the difference between now and what we lived through in 2001, 2, with the dot-com crash, the technology bubble? Back then, there was no earnings for a vast majority of those companies. And prices were just ratcheting up on a daily basis. IPOs were coming to market on a weekly basis. Crazy valuations, no earnings. People bidding up those share prices as if they were gold. It could never lose. But you saw what happened when the tide went out. You saw who was standing on solid ground, who wasn't. And so all the companies that had a ton of debt and very little earnings or no earnings, many of them went out of business. Now, that's not the case this time around. We have solid earnings, we have good growth, but we just got ahead of ourselves on the valuations. So, what are the things that we're worried about a little bit, guys? And we'll wrap this video up. Talk about what we're concerned about and maybe what we are more positive about.
I think, like we've been visiting, you know, the jobs report that came out last week, that raised some eyebrows. Okay. So obviously companies are slowing with their hiring. You're also seeing people not jumping jobs. They're not quitting their job because for fear that they can't find another one. So again, that's sign of, hey, businesses are slowing down. They're tightening up their belts a little bit. We're also seeing debt levels rise. And by that, I mean, credit card levels are high right now. 401k loans are high right now. So people they're running out of that COVID cash that you love so much, Billy. And
Yeah.
that's scary. And I think it particularly hits the lower and middle class the hardest. Okay. $100,000 income isn't what it used to be. It's hard for people to get by with a family of, you know, 2, 3, 4 on that type of income. And that makes us nervous with that. Inflation, you know, they're telling us, hey, it's tamed, it's coming down. I don't think everyone on this call or this video thinks that. They think maybe that they're just telling us that. So, you know, if the Fed ends up not cutting rates, or worst case, they had to raise rates, the market hasn't even touched pricing that in. That could cause some more volatility, you know, a surprise, a black swan event like that.
Yeah, that is a lower likelihood. They did say that there's a good chance that they'll cut rates in September, which is one thing to be positive about. But we are still watching to make sure that that's the case, because like Shaun said, if they do decide to increase or stay put, there might be an increase in volatility.
Consumer discretionary sector as a whole, 13% year over year contraction in sales. That had to happen, guys. These kind of things are the things that get hit first. Yeah. Sales in real estate obviously slowed down. Home builders are holding up pretty good because there's no inventory. People can't buy a new home right now because interest rates have curbed all of that. They've stopped. Same thing with autos, automobiles, trying to get back to the old pre-COVID highs. The IPO and M&A activity is very healthy across all regions and sectors. Okay. So there's a lot of money. Companies have a lot of money. They want to spend it. They're either going to buy back their own stock, which is going to be supportive of share prices eventually, or they're going to buy another company to build up their own earnings internally. The one thing that I'll also tell you about to watch is the earnings estimates and the reports. So when we watch companies' earnings, they come in, and by the way, they're about more than 3/4 of the way finished with earnings for this quarter. The companies that beat are rewarded less than the companies who miss are punished. So right now, if you miss earnings, if a company misses their expectations, they're getting taken out to the woodshed. And that's just because of this whole scenario of we are getting concerned about the economy. We think things are slowing. People are less enthusiastic, and we're starting to see some job losses build up.
So are you talking the R word, Billy?
Hey, a recession has been predicted for the last 2+ years.
Yep.
And remember what we talk about, the inverted yield curve guarantees, like what, 9 out of the last 10 recessions has been predicted by an inverted yield curve. We've been living through an inverted yield curve, guys, for the last 2+ years. Yep. Meaning the short-term rates are higher than the long-term rates. Eventually, that's going to normalize and get back to where it's actually makes sense, because if you put money, if you buy a 10-year bond, you should get better yield or a higher yield than the one that, at 2 years. And that's just saying that things are out of whack. Rates need to come back down, and they will. But like you said, Shaun, if you don't have $100 in your pocket when you leave your house, you can't make it. You cannot get through the day almost. When you think about it, if you go with your family, you go get breakfast, you go fill up your car, you stop at the grocery store.
I got to tell a quick story. We went to this company. It's one of those cookie companies, a Twisted Sugar or something. Kate got a cookie. My 2 girls got Lime Rickies. Okay. Lime Rickies are Sprite with grape sugar in it. Okay. It was $25. to get through that drive-through, and I about had a seizure just doing that. So it's nuts out there right now. But I mean,
it's crazy.
we're probably talking and people are like, well, God, guys, I mean, you're scaring the hell out of us. What do you mean recession? What's this mean for me? What's it mean for my retirement? What's it mean for my investments? And I mean, I'll ask you that, Billy. What's it mean for people so we can get that explanation out there?
I love when markets get volatile because the folks who want to continue to invest, who are, let's say, during their working years, these are the kind of opportunities that make everything work for you. So you want things to come back and reset. Throw a little cold water on the fire. We need to bring things down. It had to happen anyway. Now, of course, knowing it's going to happen and when it's going to happen are totally different conversations. You cannot sit in cash or you'd have missed the whole return these last several years. And a lot of people did that. You know, they see a money market, oh, it's 5%. Well, I missed 40% of the market upside.
Right.
And they're probably thinking right now, I'm so smart because I sat in cash. Well, keep sitting there and you're going to miss the next leg up. So you see, the thing is when you go to cash, you have to make another decision. When do you get back in? And how do you know when to get back in? And is the sell-off over? Probably not. I mean, we wouldn't be surprised to see a 15 or 20% correction here. And then you're going to see the real doomsdayers because they want to get themselves on TV or in social media or on your phone by predicting 50% corrections or crashes or 70% crashes. So you're going to see all kinds of scary things. And if you want to buy into that, then I guess you're going to be nervous wreck for the next however long. What needs to happen is earnings stay solid enough to support the valuations. The Fed needs to say, hey, we're going to cut and hold themselves to that. And then normalcy needs to come back in. I've been saying for so many years that the crypto thing needs to come back down to earth. And there's nothing behind that other than saying, what is it? What is crypto? All these hundreds or thousands of cryptocurrencies, are they a currency or are they some sort of an investment with no underlying value? What is it? And all this stuff got bid up mostly after COVID when they dumped billions and billions of dollars, hundreds of billions of dollars into the economy. Matter of fact, we are so far in debt that this stuff, it really needs to come down to earth. And the spending needs to come down. So all this is kind of like regulation and clockwork. And I think what we're going to see this resetting of the economy and of the market, and the markets continue to do well. Over more than 100 years, we've averaged 10% in the market. Occasionally, you're going to have a correction. What you do during that correction is all that matters.
Yeah. So either, like you said, add to it if you can, take advantage of it. If you're retired, you're already in it. You got to stay put. You got to let us make our adjustments to our models. And we're already talking about that. I mean, we were just before this call, we're talking about, we might start tiptoeing back into fixed income. We think there's probably some opportunity there, especially if rates do start to come down, like we mentioned. Those long-term bonds. Long-term bonds, extending out on that where there's maybe some more opportunity there, but yeah, let's wrap this thing up, boys. Any other comments before we go?
I was just going to say real quick that for those people that can't add money during times like this, for the people that are retired, we structure their portfolios that way with an increased weighting in cash so that we can rely on that during times like this and let their stock portfolio recover. So not to worry, we'll get through it all together.
Call us if you have questions or, you're really worried about things. Obviously, we know that things can get volatile and in your mind can get really emotional. And if you're paying too much attention or even any attention to some of these fear mongers out there, it can rattle you. And that's what we're here for. So reach out to us. We'll walk through it. We'll go through your scenarios and your investment plan and talk to you about what works over the long term. Remember, this investing is never a short-term endeavor. We're not day traders. Hang in there, folks. Thanks for listening.
Thank
you,
everybody.